Welcome back to Calvo Mateo, the channel where we cut through the market noise and hand you the real story behind the tickers everyone is arguing about. Over the next few minutes, we're going to walk through why the market just priced this technology company like a distressed asset, why the world's biggest institutions are quietly buying while retail investors run for the exits, and why a single date on the calendar could either ignite an explosive short squeeze or send this stock spiraling into penny stock oblivion. If you enjoy deep dives like this one, do me a quick favor and smash that like button and subscribe. It genuinely helps the channel grow and takes you all of 1 second. Now, let's get into it. Many retail investors looked at Datavault AI and saw an explosive technology leader sitting on an $800 million asset backlog ready to rocket straight to the moon. But the market had other ideas entirely, dragging this company down a brutal 90% from its peak. And here's the twist. What if I told you that the obvious conclusion that this company is either an outright fraud or the bargain of a lifetime is actually missing the real story? At first glance, this looks like a straightforward growth play. But there's one number, coming later, that makes that comfortable conclusion almost impossible to defend. To understand why the market reacted with such violence, we first have to look at exactly where this stock is trading right now. The reality is stark. The stock closed yesterday at 30 cents and 81 hundredths of a cent, hovering dangerously close to its absolute support floor of 24 cents and 71 hundredths of a cent. That's the 52-week low, and the all-time low rolled into one. Over 90% of this company's valuation has been wiped clean off the map since its post-acquisition peak of $4.10 back in October of 2025. This is a textbook example of a stock completely decoupling from management's ambitious promises. When a stock falls this far, this fast, the retail crowd usually panics and runs. But behind the scenes of this massive sell-off, a hidden technical mechanism is quietly being set up, one that could catch the entire market completely off guard. That sounds dramatic until you look at what's actually happening underneath the surface of the trade itself. What most people are missing is that short sellers have piled into this stock to an absolutely extraordinary degree. We're talking about 99,310,000 shares sold short, representing over 12.5% of the entire public float. That is a staggering level of bearish conviction. Now, if you're a short seller right now, you feel completely victorious. The chart is on your side. But here's the problem hiding in plain sight. With an average daily trading volume of 47,600,000 shares, it would take 8 days and 7/10 of continuous, non-stop buying for those shorts to fully cover their positions. Think about that. If even a single spark of positive news hits this stock, those short sellers become mathematically trapped. When the days to cover ratio climbs this high, any positive catalyst can trigger an explosive, automated wave of buying pressure underneath the price. It's a coiled spring and it's wound tight. And that brings us to the one question investors actually care about. Who on earth is actually buying this stock? Here's where the story starts to get genuinely complicated. While retail investors are capitulating and dumping their shares in fear, the world's largest institutional players are quietly, methodically accumulating blocks of stock. BlackRock, the single biggest asset manager on the planet, increased its position by a staggering 155%, adding nearly 7 million shares. State Street more than doubled its holdings. UBS did the same. But hold on. Don't let those enormous names fool you just yet. Total institutional ownership is still microscopically thin, sitting at just 66 hundredths of 1%. Let that sink in. This is a wildly polarized battlefield where big money is placing tiny, speculative lottery ticket bets, while the vast, overwhelming majority of the float remains firmly in retail hands. So is this smart money loading up before a rocket launch, or is it just pocket change to giants who won't blink if it goes to zero? But before you get too bullish on those institutional additions, there's another layer to this ownership puzzle that changes everything. While institutions are nibbling at the edges, corporate insiders, the people who actually run this company, have done exactly zero open market buying in the last 6 months. Zero. In fact, we've seen 10 separate insider sales, including key liquidations by both the Chief Financial Officer and the Chief Executive Officer. And it gets even more concerning. There was a recent transaction where CEO Nathaniel Bradley's entity, EOS Technology Holdings, acquired over 1,320,000 shares. Management proudly spun this as a powerful sign of insider conviction. But a close, careful reading of the SEC filings reveals a very different picture. It wasn't conviction at all. It was a desperate equity substitution. The company chose to issue shares instead of paying cash to satisfy a quarterly earnout obligation. And why would they do that? Because paying in actual cash would have pushed their dangerously depleted cash reserve of just $1,400,000 right over the edge. This cash preservation maneuver starts to make complete sense the moment you examine the absolutely brutal timeline of events this company is now facing. We are staring down an absolute gauntlet of catalysts crammed into the next few months. It kicks off with an immediate regulatory deadline on August 24th. Then comes the rollout of 3 proprietary exchanges in mid-September. On top of that, a major regulatory Senate vote, a class action lawsuit deadline on October 5th, and several massive acquisitions slated for the fourth quarter. Here's what makes this so terrifying and so exciting at the same time. Each one of these events is a binary make or break moment. If even one of these dominoes falls the wrong way, the company's grand tokenization empire could completely dissolve into nothing. But if they all align perfectly, the upside potential is genuinely massive. So the real question is, can any company thread this many needles without a single slip? The very first domino, and the one that could end this entire game before it even begins, falls on August 24th. Datavault has officially run out of time to regain compliance with Nasdaq's $1 minimum bid price rule through normal trading. There's no more runway. The immediate burning catalyst is whether Nasdaq grants them a 180-day grace period extension. If that extension is granted, it averts a forced reverse split and very likely triggers a violent short squeeze as those trapped short sellers scramble over each other to cover. But if it's denied, the company faces immediate delisting down to the illiquid, over-the-counter pink sheets. Or they're forced to execute a reverse split that would absolutely crush retail sentiment overnight. The stakes could not possibly be higher. And here's the wild card. CEO Nathaniel Bradley is actively resisting a reverse split, which only elevates the razor-thin binary nature of this single decision. But let's say they survive this regulatory hurdle. They still have to prove their entire business model is more than just a beautiful slide deck. The central short seller thesis, championed loudly by firms like Wolfpack Research, is brutally simple. They claim Datavault is merely a stock promotion with zero real-world transaction volume flowing through its blockchain. To prove those skeptics wrong, the company has to successfully roll out its information data exchange and its NIL Vault platform in mid-September. But the ultimate lie detector test, the one that truly matters, is their technical integration with the payments giant Fiserv. This launch is their one and only path to prove that their claimed $800 million tokenization backlog can actually translate into real, hard, cash-generating implementation fees. Is this the moment the doubters are silenced forever, or the moment the whole illusion finally shatters? Yet even all of this technical infrastructure rests on a much broader shift that most investors are completely ignoring. Real-world asset tokenization is a genuinely massive, world-changing trend. But here's the catch. Institutional capital cannot legally allocate serious money to tokenize rare earth minerals or to name, image, and likeness assets without a federally recognized regulatory home. And that is precisely why the Clarity Act is the ultimate macro catalyst here. This bill has already cleared the House of Representatives and a key Senate committee. The full Senate vote, scheduled for September, could grant the CFTC primary spot jurisdiction over digital commodities. In plain English, if this bill passes, it unlocks the regulatory vault. It directly validates Datavault's enormous patent portfolio, potentially overnight. Imagine a single piece of legislation flipping a company from speculative gamble to legitimate contender. But as we wait for that regulatory tide to rise, we have to confront a massive, gaping hole in this company's financial reporting. This brings us to what I call the consensus revenue paradox, and it's a doozy. Wall Street's forecasts for the company's second quarter revenue were wildly, almost comically divergent. TradingView projected $15 million and $500,000. StockTwits called for $30 million and $250,000. And Investing.com aimed sky high at $45 million. So what was the actual reported revenue? Just $6 million and $720,000. A catastrophic miss. Think carefully about what that means. When seasoned professional analysts are missing their targets by up to 80%, it tells you something chilling. Nobody, and I mean nobody, has a clear grasp of how this company actually recognizes revenue. And if the professionals are just guessing, then investors are essentially flying blind through a storm with no instruments. It points to a profound structural disconnect between management's grand backlog claims and their actual commercial billings. And this analytical blindness becomes even more alarming the second we turn to their balance sheet. The math simply does not compute. It doesn't even come close. Datavault has signed a definitive agreement to acquire a company called CyberCatch for $94,500,000 in cash. $94.5 million, but their balance sheet reveals a mere $1,400,000 in cash on hand. Even when you factor in their promissory note of $25 million and $30,000 from Streeterville, they are still tens upon tens of millions of dollars short. So unless they execute a massive, deeply dilutive secondary share offering the very moment they secure a Nasdaq extension, this acquisition simply cannot close. Investors right now are ignoring a colossal dilution tsunami that is quietly building just offshore. Would you buy a stock knowing the flood is coming? And if you think a dilutive share offering is the only risk lurking here, the legal disclosures reveal something far, far darker. Investors genuinely need to wake up to the extreme tail risks buried in the fine print. First, the company faces a major securities fraud class action lawsuit with a critical deadline on October 5th. Second, and this is where it gets shocking, the patent portfolio, the crown jewel of this entire story, relies heavily on a co-inventor named Edward Withrow III, a convicted felon with a documented history tied to past pump and dump schemes. And then there's the cherry on top. CEO Nathaniel Bradley carries a prior SEC ban from penny stock offerings, a detail that was conveniently obscured during the company's rapid pivot from consumer audio to blockchain data. Put it all together, and you have a corporate leadership team carrying an immense, staggering amount of reputational baggage. Under the strict regulatory scrutiny this company is about to face, that is an incredibly unstable foundation to build a rebound on. So when you weigh these extreme existential risks against those massive potential catalysts, you end up with two completely different futures for this company. Make no mistake, this stock is a purely binary bet. In the best case scenario, the Nasdaq extension is granted, FISF goes live and works, Project Questrel successfully monetizes its Edge AI utility tokens, and the short squeeze roars to life, driving the price past 50 cents and marching toward those ambitious analyst targets of $2 to $3. But in the worst case scenario, the extension is denied, the technical rollouts stall out, they're forced to aggressively tap their convertible debt, and relentless, unstoppable dilution collapses the stock below its 24-cent support floor, condemning it to life as an illiquid pink sheet penny stock. And here's the uncomfortable truth. There is virtually no comfortable middle ground here. It's the moon or the basement. So how on earth do we navigate this minefield over the next 2 weeks? Over the coming week, you should expect extreme, stomach-churning volatility. Under the current compliance window, short sellers will hammer this stock intraday while retail speculators chase 11th-hour options contracts, keeping the trading range tight somewhere between 28 and 34 cents. If that extension is officially announced, a relief rally to reclaim 38 cents, followed by a technical test of the 50-cent level, becomes highly probable. But if it's denied, you need to prepare for immediate, panic-driven capitulation selling, dragging the price right back down to that 24-cent floor. This, my friends, is a game of pure, cold, technical positioning. Which brings us to the final verdict. The question you have to ask yourself, are you a gambler or are you an investor? Before I give you my closing thoughts, I need to be crystal clear with you. I am not a financial advisor, and absolutely nothing in this video should be taken as financial advice. Everything I've shared today is for educational and informational purposes only. Stocks like this one are extraordinarily high risk, and you can lose your entire investment. Please always do your own research and consult with a qualified, licensed financial professional before making any investment decisions with your hard-earned money. With that said, here's my honest take. As a long-term investment, you have to treat this stock with extreme skepticism. The structural dilution, the ever-expanding share count, and the severe cash flow mismatches make it a genuinely toxic asset to hold for the long haul. However, as a short-term catalyst-driven swing trade, that coiled spring we talked about is absolutely primed and ready. The key is discipline. Protect your capital, manage your position size carefully, and remember the golden rule: trade the catalyst, but never ever marry the story. Now I want to hear from you. Here's my question, and I genuinely want your thoughtful answer down in the comments. If you had to choose right now, would you bet on the short squeeze igniting an explosive rebound, or are you convinced the dilution and delisting will win out in the end? Drop your prediction below. I read every single one, and let's start a real conversation. If this deep dive brought you value today, you already know what to do. Hit that like button, subscribe to Calvin Mateo so you never miss the next breakdown, and I will see you in the next one. Until then, trade smart, stay disciplined, and protect your capital.